You're listening to the Good Food CFO podcast, where we focus on financial strategies for building a profitable food business. I'm your host, Sarah Delavan. Today on the podcast, we're focusing on pricing, specifically how to ensure that your products are priced for business profitability. Because setting your prices to achieve product profitability does not guarantee that you can build a profitable business. I am diving into this critical financial concept and 3 rules for pricing that will help you understand your business better and ensure that your products are priced right so you can build a profitable business. You can also find today's episode on our YouTube channel with slides to illustrate the financial calculations and pricing formula that I'm going to be sharing. All right, let's get to it. Hey guys, today we are diving right into things with a critical concept for good food business owners to understand. And that is that setting your prices to achieve product profitability does not guarantee that you'll achieve business profitability. In accounting terms, the profitability of your product is called your gross profit margin, and your business profitability is your net income. Now, anyone who has ever looked at their financial reports knows that net income is always smaller than gross profit, and that you can have a positive gross profit margin, aka profitable products, and still see losses on the net income line. Now, that's because your operating and labor costs are subtracted from your gross profit, and what remains is your net income or loss. Many businesses that haven't priced their products for business profitability achieve their sales goals and achieve gross profit margins that are positive, but they struggle to achieve profitability in their business and they aren't sure why. When this goes unresolved or the source of the problem is unidentified, losses can mount and the result can be the closure of the business. So how do you ensure that your products are priced for business profitability? Well, there are 3 rules that you need to know, understand, and accept in order to get this right, and I'm sharing them with you right now. Rule number 1, your labor costs will always be higher than you initially assumed. It's absolutely helpful to know what the ingredient, packaging, and labor costs are to produce your products. And it's valuable to see those costs broken down into dollar values. But when it comes to determining the price of your product, the per unit labor cost is not helpful to you. Follow me here. It may take 5 minutes to produce 1 unit of your product, but you're going to be paying for additional labor that includes setup and cleanup, washing dishes, receiving and putting away orders, and labor that's not associated with the production of your product. Your direct labor cost to produce your product may be 5% of the product price. But if your actual labor costs are 25% of total revenue, that's going to impact your business profitability. Let me give you a real-life example from one of my clients. They're a CPG brand, and they calculated that their labor cost per unit was 69 cents. The wholesale price of their product is $6. The calculated labor cost percentage based on those numbers is 11.5%. Now, to make sure that we're all on the same page, I'm going to break that down another way and say that their calculation tells us that they expect 11.5% of the money they make from the sale of 1 jar to pay for the labor to produce that jar. But when I looked at their actual financial reports, their 12-month average labor cost is 26% of revenue. So to mirror what I said earlier, that means that 26% of the sale of every jar actually goes to pay for labor, not 11.5%. So their actual per unit labor cost is $1.50. And that's quite different than the original estimation of 69 cents. And ultimately, what that means for the business is that their product is less profitable than they thought, and they'll need to sell more units than they expected to hit their break-even point and then profitability. I want to say that I have never met a business that had a labor cost below 20% that was producing their own products. That's not to say that they don't exist, but I've never met one. So when I see a price calculation utilizing a labor cost below 20%, that's a red flag for me. So if you're asking yourself now, how can I ensure that I'm utilizing an accurate labor cost percentage to estimate and get your pricing right? It requires a more holistic approach. And that is going to take us to rule number 2 on our list. Rule number 2 is that you cannot successfully price your products in a vacuum. You need to understand the true cost to operate your business and utilize that information to price your products holistically. Now, this involves financial modeling, and I don't want you to get overwhelmed by that term because financial modeling is simply the process of pulling together your company's expected expenses and earnings on a spreadsheet and using that data to calculate the impact of future events or decisions. In this case, we're talking about the impact of the price you choose to sell your product for. So if you're a new business, your model is going to include estimates and best guesses, right? For many of the costs and for the revenue projections of your business. And that's totally okay. If your business is operational, you can use your actual financial data to put together your financial model. And when I do this, I like to use the last 12 months if it's available. You build your model with that information, and then you can make some future projections if that's helpful for you. Once you've got your data together, you can utilize your financial model to determine the financial success formula for your business. And if you're not familiar with this term, your financial success formula is the cost of goods sold, operating, and labor cost percentage targets that when you hit them will result in achieving your target profit margin or profit dollar value. This is the holistic view of your business that I mentioned earlier. Your financial success formula and understanding what those targets are allow you to consider all the parts of your business to make informed decisions. As you consider and make business decisions, you can refer back to your financial success formula and ask yourself things like, at this price point, can I achieve my financial success targets? With your financial model, you can also determine your break-even point, and you can run this scenario for different price points. So in other words, how many units would you need to sell to break even at various price points? And then at what point would your business become profitable? This is very helpful information for pricing and for planning. Taking these steps to build a financial model and determine your financial success formula before setting prices will save you time and money. They will also help you identify how to structure your business in order to be profitable. Financial modeling and the financial success formula is the central component of the work that I do with my clients and with my program members to help get their products priced right and achieve their financial goals. And I want to make sure you know it's never too late to do this work. So if you want to learn more about it, visit the website for downloadable tools or join us in the free masterclass to learn more. We've got links to everything in the show notes. Okay. Last but not least, we have arrived at rule number 3 on the list of things you need to know, understand, and accept to price your products for business profitability. And here it is. You can calculate your perfect product price based on ingredient cost alone. And you can do it for direct-to-consumer businesses, wholesale businesses. You can do this if you're a caterer or a meal delivery business. You do not have to use a big, elaborate calculation to find your product price. You don't have to factor in supply cost per unit or labor cost per unit or rent expense per unit, as I've seen some people trying to do. When you've taken the time up front to build your financial model and you know your financial success formula, then you know your target cost of goods sold percentage. And from there, you can drill down and identify your target ingredient cost percentage for every sales channel that you have. And with that information, you can utilize the following simple pricing formula. You ready for it? It's going to be 1 divided by your target ingredient cost percentage. And that outcome is then multiplied by your per unit ingredient cost. So if your target ingredient cost percentage is 20%, and your per unit ingredient cost is $2, then the formula would look like this. 1 divided by 0.20 times 2. This will give you what I like to call your suggested price. Now, I say that because depending on your cost, you may end up with a suggested price of $4.36, and that's just a weird price, right? So you may choose to round up to $4.50 or round down to $4.25, or you may elect to choose a different price point altogether based on your target market. The decision is completely up to you, and not every item you sell needs to hit your target ingredient cost percentage right on the nose. But with this calculation, and with this method for pricing, you are now fully informed on the price point that will best support your goals for building a profitable food business. Pricing this way ensures that you're hitting your target ingredient cost percentage, which then helps you hit your target cost of goods sold percentage, which is one of the primary components of your financial success formula. If you hit that, and then you hit your labor and your operating cost targets, you are on your way to business profitability. And that is what I want for you and for your business. To recap, pricing your products for business profitability requires a holistic approach. That means number 1, your labor costs are going to be higher than you initially calculated. So don't use your per unit labor cost to calculate your prices. Number 2, build a financial model and find your financial success formula using either forecasts or actual business data. And number 3, price your products with the simple formula 1 divided by your target ingredient cost percentage times your per unit ingredient costs. Looking at your business holistically and creating the right cost targets for your business offers a new way of seeing and thinking about your business, and it helps you make informed decisions, not only in regard to pricing, but really any financial decision you need to make about your business. You can learn more about the financial success formula in the free on-demand masterclass and get support in finding your formula within the online workshops and programs available on the website. Visit thegoodfoodcfo.com or check the show notes for links. If you enjoyed this episode, please like, comment, and share with other food business owners who might find it helpful. And if you want to continue the pricing conversation, join me over in our free Mighty Networks community. It's called the Profitable Food Business Community, and you can find it by searching on the Mighty Network platform or by visiting profitablefoodbusinesscommunity.mn.co. We've also got links for that in the show notes as well. Thank you for joining me here today. I'll talk to you again soon.